Hey everyone. Imagine discovering a company that quietly secured $49 million in signed agreements in just 3 months, yet the market still prices it like a speculative lottery ticket. No hype, no exaggeration. $49 million, and the stock is still trading under $1. So what's going on here? Is this one of those rare early-stage opportunities before Wall Street fully wakes up? Or is this another flashy tech narrative that looks impressive on paper but collapses under real scrutiny? Today we're taking a deep dive into Dvlt AI, ticker symbol DVLT. And by the end of this breakdown, you'll understand why this stock could either stage one of the most dramatic small-cap breakouts of the year or become a textbook example of how momentum stories unravel. Let's start where serious capital usually moves first, behind closed doors. While most microcap CEOs host generic investor webinars, Dvlt's CEO Nate Bradley took a different approach. Instead of running another routine online presentation, he organized a private strategy dinner at Mar-a-Lago. The guest list reportedly included high-net-worth investors and senior government officials. The focus? Real-world asset tokenization. Now pause for a moment. Microcap companies don't typically get access to rooms like that. They don't typically bring institutional-level conversations into exclusive private settings. That's usually reserved for firms positioning themselves for something much larger than retail attention. At the same time, the company launched a global campaign on Bloomberg television. Think about that. Bloomberg airtime isn't cheap. It's not something small companies casually experiment with. It's strategic. It's intentional. So the key question becomes, are they preparing for a legitimate institutional wave? Or is this high-budget visibility simply theater designed to attract retail momentum before insiders quietly exit? Now, here's where things take an even more interesting turn. Instead of quietly testing their technology in a controlled lab environment, Dvlt used one of the most chaotic environments imaginable as a live stress test. Super Bowl weekend. They deployed their proprietary ADIO data oversound technology along with DV Holo holographic systems to authenticate and monetize live audience engagement. Let's think about what that means. The Super Bowl isn't just loud, it's unpredictable. It's one of the highest noise, highest traffic events on the planet. If a system can operate reliably there, theoretically it can handle almost any commercial setting. But the real question isn't whether it sounded impressive in a press release. Did it actually perform? Was it a legitimate, large-scale validation of their infrastructure? Or was it simply a highly visible marketing demonstration? Because there's a massive difference between technological capability and promotional spectacle. Now let's shift to partnerships. Because in small-cap investing, partnerships are often used as credibility anchors. Dvlt announced that Sports Illustrated is building a proprietary digital asset exchange on its infrastructure. NFL Alumni Health is leveraging the ADIO technology for real-time public safety messaging. These aren't anonymous startups. These are recognizable brands, established names, organizations with reputations that matter. When companies of that scale integrate technology, even on a pilot basis, it signals at least some level of due diligence. But here's the hard truth. Pilots don't always become long-term contracts. So the real evaluation isn't who signed. It's how deep does the integration go? Are these short-term experiments or recurring revenue relationships that compound over time? Now we arrive at the numbers because ultimately revenue tells the truth. In the fourth quarter of 2025 alone, Dvlt signed $49 million in tokenization and licensing agreements. Not speculative pipeline projections. Not vague letters of intent. Signed agreements. For a company currently valued like a penny stock, that's not minor progress. That's a credibility shift. However, and this is critical, signed agreements are not the same as cash collected. Markets have seen this story before. Big contracts announced, headlines celebrated, then revenue recognition gets delayed, restructured, or partially booked. So the essential question becomes, How much of that 49 million converts into actual reported revenue? And when does it show up on the balance sheet? Management has set a fiscal 2025 baseline of over $30 million in revenue. That represents roughly 1,000% year-over-year growth, a tenfold increase in a single year. If they achieve that, it signals a transition from concept validation into what I call the velocity phase, where growth begins feeding on itself. But guidance is not a guarantee. Ambitious projections can inspire confidence or destroy credibility if missed. And here's where the projections get aggressive. The company has outlined a roadmap pointing toward $200 million in 2026. Then, and this is where it becomes almost unbelievable, $2 to $3 billion by 2027 through their real-world asset tokenization expansion. Let's be honest, moving from 30 million to multiple billions in 2 years isn't just growth. It's exponential acceleration bordering on moonshot territory. For that to happen, execution must be nearly flawless. Infrastructure must scale rapidly. Partnerships must convert smoothly. Regulation must align favorably. Capital must remain available. What are the odds everything lines up perfectly? Because in small cap investing, execution risk is everything. Now consider their operational strategy. Beginning in the second half of 2026, Dvlt plans to deploy an AI-driven monetization network across 100 U.S. cities. The primary targets: healthcare, insurance, and finance. These are extremely high-value verticals. Data monetization in these industries isn't incremental, it can be exponential. But scaling across 100 cities requires enormous operational discipline. It requires capital, regulatory compliance, regional partnerships, deployment teams. Does the company possess that kind of infrastructure? Or are they attempting expansion at a pace that stretches resources thin? The technological backbone behind all of this is their AI platform operating on GPU-powered edge nodes. Edge computing allows data to be processed locally at the source, improving speed, efficiency, and security. That's a legitimate macro trend. Edge AI is widely viewed as a core component of future digital infrastructure. But here's the competitive reality. Amazon, Microsoft, and Google dominate much of this ecosystem. So the strategic question becomes, is Dvlt competing head-to-head with trillion-dollar giants? Or are they carving out specialized niches too small for the hyperscalers to prioritize? Now let's talk valuation. The stock currently trades in the 70-cent range. Analyst targets have been placed around $4. If achieved, that represents roughly a 5x return. But analyst targets are built on assumptions: revenue realization, execution consistency, dilution control. And dilution is the silent variable here. Over the past year, the share count has expanded significantly. There's also an active shelf registration allowing additional shares to be issued. In small caps, dilution can quietly erode gains. Even if revenue grows tenfold, excessive share issuance can neutralize shareholder returns. So investors must ask, is capital raising nearing completion? Or is this an ongoing funding cycle that continues expanding the float? Finally, timing. February 15th, 2026 is a major checkpoint. That's when full fourth quarter results are released. We'll see how much of the announced agreements convert to recognized revenue. After that, watch the first half of the year for licensing maturation. Then the second half of 2026 becomes the execution phase with the 100-city rollout. Each milestone acts as a binary catalyst. Strong execution could trigger re-rating momentum. Missed targets could unravel the thesis quickly. So where does this leave us? Dvlt AI sits at a crossroads. On one path, accelerating revenue, validated infrastructure, expanding partnerships, controlled dilution, and potentially dramatic revaluation. On the other path, delayed revenue recognition, aggressive projections missed, continued dilution pressure, and fading investor confidence. This isn't a simple bullish or bearish story. It's a high-risk, high-reward inflection point, and the market hasn't fully decided which direction it believes. The question is, have you? Because in the small cap world, fortunes aren't made when certainty arrives. They're made or lost in moments exactly like this, and the next few quarters may determine everything. This is not financial advice.